Hi friends, Namaste. Welcome all of you to my channel. Today let's discuss about the one example that is all about how we could estimate the probable bad debt by using the percentage of account receivable approach. In my last video related to estimation of the uncollectible account, we have basically the two approach. One is called direct write-off approach and next one is that under allowances approach we have percentage of sales and next one is that percentage of receivable approach. Now this question is particularly percentage of receivable approach, and particularly I am taking these questions from this Porter Norton Financial Accounting, the impact on decision makers. In page number 341 to 342 you will find that's wonderfully illustrated by the authors, and I try to just simplify the whole process of solving this question, friends. Now based on this background, let's move to the given information. Basically you are given the years up to 2009 to 2013. You are given next column is the receivable. I try to organize this all information in this sheet, and bad debt information we have. Now what I did here, now over the 5-year period I just calculated the sum figure, and again the bad debts is the sum figure. Now your job is to here you have to estimate the, as per first question, even the ratio of the bad debt to ending balance in account receivable over the past 5 years, friends. So you see that this figure divided by this one or into that's a 100. So we came to know that that is a 0.80 percentage would be the bad debt ratios over the past 5 years. Now let's move to the second questions. Assuming the balance in account receivable and allowances for doubtful account on December 31st, 2014, that is the 8,65,000. That is why I have organized for 2014 we have 8,65,000, and that is why now you are going to estimate record the journal entry, and you try to show in its effect in accounting equation, income statement, and including how we prepare the T accounts, right? And what would be the net realizable value? That is the question. Okay. No, now when you record the journal entry, that's framework is that bad debt expenses account debit to allowances for doubtful account, or you can say that uncollectible account expenses to allowance for doubtful account. Now, how we came to know that what would be my this value, right? So credit balance required in allowances account. Look at this figure. Then credit balance, that is simply look at the term, that is credit balance in allowances account before adjustment, that is given, that is the 2100. Okay. Now credit balance in allowances is that simply we already calculated, by the way, right? Simply what we did here, this is this value into, since this is given in the percentage, so you need to divide by 100 again. So that is 6925.57. It seems to be a little bit different than that of your author calculation, just because of this approximation. Anyway, this is correct answer. Yeah, calculation you can say. So this value minus this, so you would have a value of 4825.57. Okay. Now your journal entry would be here. You can write that's a dollar that is 4825.4. Yeah, that is the 57, and in credit also you can write the same, that is the dollar 4825.57. Okay. Now this is your working note. Now I would like to know its effect in the balance sheet, that is accounting equation. Okay. In accounting equation, look at the term, that is the A equals to L plus E. A is the assets, L is the liabilities, and E refers to your stockholder equity or shareholder equities. So allowances for doubtful account, here I just mentioned here asterisk sign. This is, you can write, is the allowances for doubtful account, but when you are recording it in asset side, then that value would be 4825.57. Okay. Then look at your, what will happen to your equity. Even in equity value, that will be same value, 4825.57. Okay. Okay, then look at your revenue and that's revenue minus expenses is called, we say that is the net income, right? Then in this case what you'll do, like your income statement, look at your revenue part. Revenue is that, okay, that's a bad debt expenses. We don't have revenue, but however we have a amount is that 4825.57. This is in point figure. Okay. Okay. Then, okay, this is, by the way, not the revenue, don't be confused here. This is expenses. Okay, I would just merge it. Okay, that is the, simply is the expenses, right? Now what about the income? For income you would have again, that's a negative value, since this is not the case of revenue. So your net income would be again 4825 point, that is 57, friends. Okay, and that is the basic reason, when our net income is negative, our equity, stockholder equity, will be also negative. Okay, that is the point that you need to understand here. Now next one is that again we have to do our working notes, T accounts. So balance before adjustment, adjusting entry, and the balance after adjustment. And balance before adjustment is, as per given question, we have a $2,100, and next one is that balance after adjustment we have, this is the value. I would just copy it and paste this. Okay, I would just because I need to take the value it. Yeah, I would just okay, that is the simply 6925.57. Okay, so adjusting entry amount would be, we already did it, by the way, this value minus this value. You already calculated, by the way, this figure. Okay, so this is our T accounts. Now the question, again you have to interpret your result, that is the adjustment of dollar, that is our dollar that we just calculated is the dollar, how much we have. Okay, dollar 4825.57, right? Results in the balance of how much is the, which is the that's a dollar, how much is this, is the 6925.57. okay, which is simply 0.8% approximately, right? So I just try to fill the gap here, right, based on the all calculations, and of account receivable of 8,65,000. That is why your net realizable value would be, friends, our account receivable for 2000. You are going to find the net realizable value for 2014. So 8,65,000 as per given question. Now allowances for doubtful accounts is, this allowances for doubtful account, you have to use this value, that is, yeah, this one, 69, yeah, 6925.57. that is why your net realizable value that we would be showing in the balance sheet, this is minus this. Okay, this is my net realizable value that would be reported in the balance sheet, friends. Okay, friends, basically what I discussed, it seems to be complicated, but it's a simple process is there. It's all about, based on the given informations, I tried to organize the whole information first. Then as for the required questions, I just calculated the ratio of the bad debt to ending balance, that is the 0.80%. Then as per the given information, we have 8,65,000 is our receivable. Now I would use this ratio, right, to find the this value, and this value would be 6,925. Now once we have a credit balance, basically the credit balance would be the case when we overestimate the probable bad debt. In that case we would have a credit balance. Anyway, this is given in the question, so you would be adjusting this journal entry and you would be showing in accounting equation, and since we have a net income is negative, this is not the revenue by the way, this is the expenses, so you would have a negative, right? Then T account, I have created it and I just fill in the blanks as for this calculation, and that's why I came to know that yeah, we have a net eligible value is that 8,58,074.4043 dollar, friends. Okay friends, I hope that whatever I discussed today, that would again clarify the concept of percentage of account receivable approach, even though I have take the reference of this American authors. If you have any questions, please let me know also. Thank you all of you for watching this video. If you like this content, please like, subscribe, and also share my channel, that is the Finance Guru, Pawan Kumar Jha. Thank you.